Hello everybody, this is Breaking the Mould. It's our regular market review and this is the Christmas edition. So we're wishing you all a very Merry Christmas. I'm wearing my Christmas jumper and of course, Russ Mould, what has happened to your Christmas jumper?
I do have a Christmas hat, but it's yellow, white and blue Leeds United coloured, so it's not really quite the same, is it, I admit. Sorry.
It's not indeed.
I'll make more of an effort.
Russ, this week, what is the fuss?
The fuss. Second time in a row, I know. Don't want to sound like the ghost of Christmas past going on and on and on. But it is all about the US Federal Reserve. They've taken the momentous decision to start to taper quantitative easing. So if I had the hat on, I'd now be eating it because I really didn't expect them to do that. So sorry about that, everybody. They've knocked it down from $85 billion to $75 billion a month. Now, that's still a huge number. It's still very, very loose monetary policy. And Chairman Bernanke has said, I'm going to keep interest rates near zero, even if the 6.5% unemployment target is met for some time. So the markets are pretty happy with that because he's still sort of really playing fast and loose.
Okay, so that's what happened. I'm trying to make a joke there.
I know,
it's not
it's
working.
not quite, sorry.
Not really working.
No.
But the markets, as we know, are forward moving. So what have we got to look forward to over the Christmas period?
Actually, corporate-wise news flow, there's absolutely nothing planned at all. But don't forget, companies have got a terribly bad habit of sneaking profit warnings out on Christmas Eve, so keep your eyes peeled. That naughtiness aside, which I'm sure Santa wouldn't forget about, what you're actually going to have is, Japanese inflation on Christmas Day. Not interested in that, are you? So we'll move on. No corporate news. Let's talk about the possible scenarios, big picture for 2014, and there are 4 of them.
Okay, so let's have the first one then.
First one is, same as we are, thank you very much indeed. Very loose monetary policy from the central banks, very low inflation, reasonable economic growth, not much change. And frankly, for equities, that's probably the dream scenario. Bit of growth, bit of inflation, bit of cheap money. Thank you very much. It's worked perfectly in 2013, and more of the same would be very, very well received. People would still look at cyclical stocks. They'd probably look at a little bit of pricing power. They'll look at some quality growth names if economic growth doesn't tear around. So a balanced portfolio, bit of growth, bit of defensives, bit of yield, is probably where most people would feel quite comfortable if that's the scenario that plays out.
Okay, so do you think that's the most likely scenario?
It's the consensus view. Probably means it won't happen, Murphy's Law being as it is. The one worry with that is that the last American Investor Sentiment Survey, 3/4 of investors surveyed were bullish, 14% were bearish, massive gap. In fact, the biggest gap since September 87, just before the last big crash. So we don't want to be complacent by any means, and valuation is therefore still very, very important. But that Goldilocks, not too hot, not too cold scenario is probably the optimal one for equities at least.
Okay, so moving on from that one, what's the second scenario?
The second one is it does go quite badly wrong, and the central banks don't win their battle, and actually the government and consumer debts are too strong. We get a deflationary slump. Economic growth goes negative, prices, the cost of living actually falls, so the value of the cash in your pocket actually goes up. But it's never a great thing for investments in equities. It's a good thing for bonds, actually quite good for cash in the bank, not bad for dividend yielding companies, but that wouldn't be a great scenario. It's not happened in the West since the 30s. Japan's had it since the 90s, but the central banks see that as the absolute one thing they will fight to avoid. It would probably mean tapering is abandoned and they go back up again. Might get people excited about gold, for example, because of money printing, but that would be not a pleasant scenario to consider.
So I'm thinking then that the third one would be the complete opposite of that.
Spot on. Yeah, then you've got a rip-roaring 1980 style champagne-fueled inflationary recovery when everything goes tonto, and that would, be, I think for equities initially quite good. People would flock towards cyclicals, miners, retailers, for example, or metal bashers, IMI, Marks and Spencers, Rio Tinto. But then the central banks would have to act, clamp down, start increasing interest rates. Again, that would give people a little bit of pause for thought. It wouldn't be the end of the world. It wouldn't be great for bonds, and it wouldn't be great for stodgy, boring utilities. But overall, it wouldn't be the end of the world, but it would be a different dynamic.
Okay, so the fourth scenario then.
That's the worst one of the lot. That's the one you don't want to think about. Back to the 1970s, actually. Bay City Rollers, top of the charts. Leeds United, top of the league. Actually, it wasn't all that bad, was it? Oh, the flared trousers thing? No, okay, we'll move on. It wasn't great, and it was horrid for equities. 73.4. Economic growth was 0, inflation was 15, 20%. You wouldn't go back to that, but that's what you don't want of nothing happening inflation growth-wise and inflation bubbling up. It kills equities stone dead. The only way you'd get round that would be to buy things you can either stick down your throat or down the sink. So household goods companies, food retailers, they'd be all right, and that's worked in the 70s. but that's not a great scenario. It's the least likely one by miles. It's only happened once, but it is something you need to be aware of again when you're thinking of valuation and what risks does my portfolio face across the different asset classes that you've got.
So by the sounds of all of that, 2014 is definitely not going to be a boring year.
It's going to be fantastically exciting. They always are. I've been doing this for 23 years, still seeing things I thought I'd never see in my wildest dreams. Looking forward to talking to you all about it over the next 12 months.
Yeah, exciting stuff. So of course we'll be back with you here in 2 weeks' time. But from myself and Russ, we'd like to wish you
a very Merry Christmas.